Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll begin with Accounting Chapter 6, Unit 5, that is Account Current. Let us begin. This is the first lecture of Unit 5, Account Current, and we are doing Chapter 6, Accounting for Special Transactions. Let's begin with the learning objectives. After studying this unit, you will be able to understand the meaning of account current, learn the methods of preparing account current, namely preparation of account current with the help of interest tables, by means of product, and by means of balances. By means of product is the very famous method of preparing account current. If in the question the method is not specified, in that case we need to use the second method, that is the means of product. Understand the calculation procedure involved in the preparation of account current. Calculation procedure. Overview of the chapter. Ways of preparing account current: with the help of interest tables, by means of product, by means of product of balances. These are the three methods of preparing account current. Introduction. An account current is a running statement of transaction between parties for a given period of time and includes interest allowed or charged on various items. It takes the form of an ledger account. Some of the situations when account current is prepared are: first, it is prepared when frequent transactions regularly take place between two parties. An example is of manufacturer who sells goods frequently to a merchant on credit and receives payment from him in installments and different intervals and charges interest on the amount which remains outstanding. A consignee of goods can also prepare account current if the latter is to settle the account at the end of the consignment and interest is chargeable on outstanding balances. An account current is also frequently prepared to set out the transactions taking place between the banker and the customer. It is prepared when two or more persons are in a joint venture and each co-venturer is entitled to interest on their investments, and also separate set of books of accounts are maintained for it. An account current has two parties, one who renders the account and the other with whom the account is rendered. This is indicated in the headings of an account current, which is like the following: A in account current with B. It implies that A is the customer and the account is being rendered by him to him by B. B is rendering the account to A and A is the customer. Preparation of account current. There are three ways of preparing account current: with the help of interest table, by means of product, by means of product of balances. These are the three methods. We are starting with the method 1, that is preparation of account current with the help of interest tables, individual method. According to this method, all the transactions are arranged in the form of an account. There are two additional columns on both the sides, such as account A. One column is meant to indicate the number of days and from the due date of each transaction to the date of rendering the account. If no specific date is mentioned as the date of which the payment is due, the date of transaction is presumed to be the due date. B. The other column is meant for writing the interest. When, with the help of ready-made tables, interest due on different amounts at given rates for different period of time is found out, and this is entered against each item separately. Second method, preparation of account current by means of product method. When this method is followed, the way of preparing the account current remains the same. In this method is only the method of calculating interest is different. Under the previous method, interest column is provided on both the sides of the account current, and interest in respect of each item is found out from the ready-made interest table. In this method, interest column are replaced by product column. Product is this case is the amount multiplied by the number of days, for which it has been outstanding. Interest on a certain sum of money from a certain number of days is the same over here as interest on the product of 1 day. In other words, with the view of reduce the period of each transaction to 1 day, the amount of each transaction is multiplied by the number of days. The product is entered against each transaction, the product column. The remaining steps are as follows. Find the balances of the product on the two sides. Calculate the interest at a given rate on the balances of the product for a single day, 1 day. Either interest on the appropriate side of the account column. This entry is made on the side other than that on the balance of the product appears. Third method of computing the number of days. Usually, any of the following two methods is used for calculating the number of days. First, forward method. Under this method, the number of days are calculated from the due date of the interest to the date of closing account. Second, backward or epoch method. Under this method, the number of days are calculated from the opening date to the statement to the due date of the transaction. Red ink interest. What is red ink interest? In case of the due date of a bill falls after the date of closing the account, then no interest is allowed for that. However, interest from the date of closing to such due date is written in red ink in the appropriate side of the account current. This interest is called red ink interest. The red ink interest is treated as a negative interest. In actual practice, however, the product of such bill, the value of bill X due to the closing date is written in an ordinary ink in a positive side on such a bill is entered. It means that the interest from future date from the date of account current, that is present date, in earlier periods, it was written in the red ink. Hence, it got the name of red ink interest. It implies that the rebate will be allowed or interest paid or received if settlement of future due transaction is done on the account current date. This can also be understood in different way. In a account current, interest is calculated on the amount of bill from the date of transaction to the closing date of the period. In case the due date of the bill falls after the closing date of the account, then no interest is allowed for that period. Such interest is customarily written in red ink in the appropriate side of the account current. The interest is called red ink interest and treated as negative interest. Let us begin with the third method. Method 3. Preparation of account current by means of product of balances in case of banks. This method, also known as periodic balance method, is usually adopted in case of banks, whereas the balance of the amount is taken out after every transaction In this case, the number of days written against each transaction are the days counted from its date or due date to the date of following transaction. In the case of last transaction, the number of days is counted to the close of the period. Each amount is multiplied with the number of days. If the amount represents a debit balance, the product is entered on the debit product column. If it represents the credit balance, the product is written on the credit product column. The debit product and credit product are then totaled up. Interest is calculated on each total at the given rate of interest. The net interest is ascertained. If net interest is payable to the customer, it will appear as by interest. If it is due from the customer, it will appear as to interest account. Let us move ahead. Do some notings. Account current is a running statement of transaction between parties for a given period of time, which includes interest paid or allowed on various items. I believe you understood. Let us continue. Account current is prepared when two parties have voluminous transactions among themselves. In account current, two parties are involved. They are one who renders the account, one to whom account is rendered. If the name of account is A in account current with B, A is basically to whom account is rendered, and B is basically who renders the account. Write a note over here. Make all entries placing yourself in the position of B. So always think you have to render the account and you have to make journal entries accordingly. You have to render the account. So B who renders the account. So make all the entries placing yourself in the position of B. Let us move ahead. Account current is prepared by three methods. First is interest table method. Second is product method. And third is product of balance method. Product of balance method. Write a note. If the question is silent, use product method. Use product method if the question is silent. Interest table method. Interest is calculated for each transaction separately. Next is product method. Interest is calculated for one day on the balance of product arrived at. And third method, product of balance method. Interest is calculated separately for both debit and credit product. It is used by bank for preparation of current account. It is used by bank for preparation of current account. Next is how to calculate days. How to calculate days. Due date is not counted. Due date is not counted, whereas whereas date of settling date of settling rendering account is counted. In case of opening outstanding, in case of opening outstanding, date of opening outstanding and date of rendering account both are considered. Both are considered. Next, in case calculating days for bank interest, days of deposit shall be ignored and date and withdrawal shall be considered. Date of deposit shall be ignored and date of withdrawal shall be considered. Let us move ahead. Next is red ink interest. Red ink interest. When due date when due date of bill falls after falls after the date of closing the date of closing of account then the amount of interest then the amount of interest falling due from account closure date to due date is written on opposite side in red ink and is therefore called as red ink interest. When due date of bill falls after the date of closing the account, then the amount of interest falling due from the account closure date and the due date is written on the opposite side in red ink and therefore called as red ink interest. Note: Note: Due date of sale return when sale return is after due date of sale would be the date of sale return shall be the due date of sale return. Do it once more. Due date of sales return when sale return is after due date of sale. In that case, the date of sale return shall be the due date of sale return. Next, due date of sale return when sale return is before the due date of sale. In this case, the due date of sale shall be the due date of sale return. The due date of sale shall be the due date of sale return. Let us move ahead. Question 1. Let us do question 1. From the following transactions in the books of Big, From the following transactions in the books of Mr. Big, prepare an account current by means of product to be sent by him to Mrs. Minnie for the quarter ending 31st March 2007. Interest is to be charged and allowed at the rate 12% per annum. We need to understand who will make the account over here. So it is written over here by means of product to be sent by him to Mrs. Minnie. This means what Mr. Big has to give account to Mrs. Minnie. So we have to make Mrs. Minnie in account current with Mr. Big. Transactions are given over here. Mrs. Minnie in account current with Mr. Big. With Mr. Big. Interest calculated up to 31st March 2007 at the rate 12% per annum. 31st March 2007 at the rate 12% per annum. Let us make the columns now. Date, particulars, due date, amount, days, product. This is one side. These same columns needs to be prepared for another side. Date, particulars, due date, amount, days, and product. Let us begin with the question. On 1st January 2007, the balance is given over here. Balance in Minnie's account, it's a credit balance 3500. Credit side, 1st January 2007, by balance carried down, amount is 3500. What will be the due date? The same date will be the due date. Opening date will be the due date. Let's move ahead. 12th January, sold goods to Minnie. So Minnie to sales. Minnie account debited to sales account 30,000. And the due date is 1st February. So Minnie to sales, 12th January, 12th January 07, and the due date is 1st February, 1st February 07. Amount 30,000. Let us move ahead. January 31st, sold goods to Mini, due date is 15th February. 31st January, Mini account debited to sales account, due date is 15th February. Amount is 27,500. 27,500. Let us move ahead. January 31st is done. February 15, cash received. Cash account will be debited to Mini account. So in the account of Mini, we'll write buy cash. Cash received on 15th February, 40,000. 15th February, buy cash 40,000. Same will be the due date, 15th February 07. Next, 20th February, buy cash 7,500. 20th February, buy cash 7,500. Same will be the due date. Next transaction, goods returned by Mini. Goods returned by Mini. So it's a sales return. 10th of March, 7,000. Sales return account debited to Mini. So 10th March 07, by sale return 7,000. In this case, what would be the due date of sales return? So we have written a note and we have understood that in case of sales return, we need to understand this sale return is of which sales. This is of this sales on 12th January, or this is of this sales on 31st of January. Now you should understand one thing. In case of sales return, just read the note. First note, due date of sale return, when sale return is after the due date of sale. When the sale return is after the due date of sale. Kindly check the due date of sale in both the cases. The due date of sale is 1st February and 15th February. This means sales return happens after the due date of sales. Sale return happens on 10th of March, which is after the due date of sales, that is 1st of February and 15th of February. In this case, the date of sale return will be the due date. Read from the text. Date of sale return shall be the due date of sale return. So over here, the date of sale return is 10th of March. So we will write 10th of March will be the due date for the sale return. Let's move ahead. Cash received 6,500 on 25th March. On 25th March by cash 6,500. The due date will be 25th March. Now just calculate the number of days. In the opening balance, both the dates should be taken into consideration. So for the calculation of opening balance, the number of days 1/1/2007 to 31st March 2007, both the dates should be taken into account. So 1/1/2000, January 31 days, February 28 days, and March 31 days, total 90 days. In case of here, calculate the number of days. 15/2/2007, the due date is 15/2/2007. So 31 minus 15, 28 minus 15, 13 days, plus 31 days in March, 44 days. In case of opening balance only, both the days should be taken into account. Over here we need to leave this date from 16th to 28th of February, that is 13 days, and 31 days in March, 44 days. Likewise over here 28 minus 20, 8 days plus 31, 39 days. Next, 10th March 2007. So 31 minus 10 is 21, 21 days. And over here 31 minus 25 is 6 days. Likewise, calculate the days over here also. 28 minus 1st of Feb minus 1, 27 plus 31 days of March, 58 days. Likewise 15th February, so 44 days. We have calculated 15th February over here, 44 days. Now we need to do the product. 58 multiplied by 30,000, 58 multiplied by 30,000, 17,40,000, 17,40,000, 2,75,000, 27,500 multiplied by 44 is 121,000. Over here 90 multiplied by 3,500, 315,000. 44 multiplied by 40,000, 176,000. 39 multiplied by 7,500, 292500. 7,000 multiplied by 21 days, 147,000. 6,500 multiplied by 6 is 39,000. I believe you understood. Just do total of the product column over here. Total of the product column 174 zeros plus 121 zeros. It is 295,000. The same total should be transferred over here. 295,000. Calculate the balance over here. It is 396,500. The balancing figure of product. Right over here the last date 31st March 2007 by balance of product. By balance of product 3,96,500. 3,96,500. On this balance we need to give interest. So 31st March 2007 on another side in amount column to interest 396,500 multiplied by the rate of interest is given in the question 12%. For 1 day we need to give, so 1 upon 365. Do it on your calculators. 396,500 multiplied by 20% multiplied by 1 divided by 365, 130. In amount column write 130. 130. This interest is on this balance, and now calculate the balance carried down of the amount column. So 3,500 plus 40,000 plus 7,500 plus 7,000 plus 6,500, 64,500. And over here 30, 50. Okay, so this side is big. Amount 64,500. On here 64,500 minus 130 minus 27,500 minus 30,000, it is 6,870. 6,870. Closing date 31st March 2007, and 2 balance carried down. We'll write 2 balance carried down. I believe you understood. This. So this was product method. Method number 2, product method. Let's move to the next question. Let us continue. Next question. Question 2. From the following particulars, prepare an account current to be rendered by A to B at 31st December 2007, and interest is 10% per annum. Solution. These are the transactions given. B in account current with A. B in account current with A. So rendered by A. So account current with A. Write interest up to closing date 31st December 2007 at the rate 10% per annum. 10% per annum. Make columns. Date, particulars, due date, amount, days, and product. Date, particulars, space management is required. Due date, amount, days, and product. First, July 1, balance owing from B 600. 1st of July 07 to balance brought down. Due date 1st of July 07, 600. Next question, goods sold to B 1st July, then 17 July, sales. Goods sold to B, B2 sales 50. 17707 to sales 50. 17707 is the due date. Next, 1st August, cash received 650. Date 1st August 1807, cash received by cash 50. Due date is 1807. Next, 19th August. 19th August, sales to be 700. 19807 to sales 700. To sales 700. Due date is 19th August 07. Next is 30th August, goods sold 40. 30th August to sales 40. Due date is 30th August. Next is 1st September. B accepted a bill at 3 months date. 1st September, B accepted a bill. B accepted a bill. So it's a bills receivable. So it would be bills receivable account debit to B. Bills receivable. By bills receivable. By bills receivable. 1st September. 3 months date. September, October, November, December plus 3 days of grace. 3 days of grace. So 4th December 07 for 250. On 1st September, cash received 350. 1st September, cash received. By cash 350. 1st September 07. Next, goods bought from B. But goods bought from B. So this is purchases 30. Purchase account debited to B. Right, by purchases. The date is 22/10/07. Amount is 30. November 12. Amount is 30. October 22. Amount is 30. Due date is 22nd of October. Next, November 12, goods sold to be 20. November 12, so 12 November, 2 sales 20. Due date 12 November. Next, cash received from B. Cash received from B 80. Date December 14. 14 December 07. By cash 80. 14/12/07. Now we need to calculate the days. This is the opening balance. Calculate days quickly in this case. Both the days should be taken into account. 1107. So this is July 31, August 30. Quickly do the totals. So July 31 days, August 31 days, September 30 days, October 31 days, November 30 days, and December 31 days. Total days 184. Total days 184. Same calculate over here. 17/7 to 31st of December. Exclude this date 17/7. So 31 minus 17 is 14, and rest total do accordingly. 167 days. It is 134 days over here. 38 7 123 days. 12 November. 30 minus 12 plus 31. 49 days. Do the calculation of days on the credit side. 152 days. Exclude these dates. 27 days, 121 days, 70 days, 17 days. Now we need to do the product quickly. 600 minus 184. 110400. 50 multiplied by 167. 600 multiplied by 184. 110400. 50 multiplied by 167. 8350. 700 multiplied by 134. 93800. 40 multiplied by 123. 4920. 20 multiplied by 49. 980. On the credit side, this amount is 650. Make it 650, the first amount. See over here, 650. So 650 multiplied by 152, 98,800. 250 multiplied by 27, 6750. 350 multiplied by 121, 42350. 30 multiplied by 70, 2100. 80 multiplied by 17, 1360. Do the total of the product column quickly. 110400 plus 8350 plus 93800 plus 4920 plus 980. It's 218450. 218450. 218450. Calculate the balance. Minus 98800 minus 6750 minus 42350 minus 2100 minus 1360. 67090. Balance is 67090. Right over here the closing date 31st of December 07. By balance of product. By balance of product 67090. Now on this balance of product we need to give 1 day interest in the amount column on the opposite side. So to interest. Closing date 31st December 07. 67090 multiplied by 10% multiplied by 1 upon 365. In amount column 18. Do the total of amount column on both the side. Let's see the balancing figure comes on which side. 600 plus 50 plus 700 plus 40 plus 20 plus 18. 1428. Credit side 650 plus 250 plus 350 plus 30 plus 80. 1360. So we'll write 1428 over here will be transferred on the credit side. 1428 over here the balancing figure minus 1360 68 68 31st 1207 by balance carried down 68. I believe you understood. So we have completed question number 2 here. I believe you understood the question well. Let us see once more. Let us continue. Next question. Question 3. Mr. A owed 4,000 rupees on 1st January 2007 to Mr. X. Mr. X of the following transaction took place between them. The following transaction took place between them. It is agreed between the parties that interest at the rate 10% per annum is to be calculated on all. These are the transactions given over here. They agreed to settle their complete accounts by single payment on 15th March 2007. Prepare Mr. A in account current with Mr. B. Prepare Mr. A in account current with Mr. B, with Mr. X. So we need to prepare in the books of X Mr. A's account and ascertain the amount paid. Ignore days of grace. Fine. If the question is giving the instruction ignore days of grace, we will be ignoring the days of grace. In case of bills, I believe you understood. Let us continue. Solution. Right. A in account current with X. Interest up to 15th March 2007. Interest up to 15th March 2007 at the rate 10% per annum. Let us make the columns quickly. Date, particulars, due date, amount, days and product. On the credit side, date, particulars, due date, amount, days and product. Let us begin. Let's see the first transaction. A owed on 1st January 2007. A owed 4,000. Okay. So 1st January 2007 to balance brought down To balance brought down, amount is 4,000 and due date is 1st January 2007. Next transaction, 15 January 2007, X sold. X sold goods to Mr. A 2230. A2 sales 2230. 2230. 15 January 07. Due date 15 January 07. Next, 29 January 2007, Mr. X bought goods from Mr. A. Purchases 1200. 29th January 29107. Buy purchases 1200. Due date 29 January 07. Next entry, 10th February 2007, Mr. A paid cash to Mr. X 1000. Cash paid 10th of February. 10th February 07 by cash 1000. The due date is 10th of February 07. Next, 13th March. Mr. A accepted a bill drawn by Mr. X for 1 month. It's a bills receivable for Mr. X, so bills receivable account debited to A. It's bills receivable account debited to A. So it is by bills receivable. The due date is 13th of March 07. 1 month, so 13th April 07. Grace days is not applicable, the 3 days of grace, because it is specified in the question. In amount column 2000. In amount column 2000. Students, you must have observed over here that the date of closing of account is 15th March 2007 and the due date of bills receivable is 13th April. That is after the date of closing of account. So, for the difference between the duration of 15th of March 2007 to 13th April 2007, we need to calculate the days, or for that many days, red ink interest is to be written on the opposite side. See the notes that we have written. You will find this information. Red ink interest. When due date of bill falls after the date of closing of account, date of closing of account is 15th March 2007 and due date of bill is 13th April 2007. That is after the due date after the closing date of account. Then the amount of interest, that is amount of interest is falling due from account closure date to due date is written on the opposite side of red ink and therefore called as red ink interest. I believe you understood that information. Let us do the accounting over here. So on the opposite side we need to calculate two red ink interest. Amount of bill is 2000. This 2000 multiplied by how many days? Multiplied by how many days? We need to calculate the days. So 31 minus 15, 16 days of March and 13 days of April, 29 days. 2000 multiplied by 29. In amount column, 2000 multiplied by 29, write in the product column directly 58,000. In the product column, write 58,000 directly. Now, let us do the calculations of days. Take both the days into consideration, opening and closing both. So it would be 74 days over here. Over here, it is exclude this date, 15th of January, it is 59 days. 29 January, exclude this date to 15th of March, 45 days. 10th February, exclude this date, it is 33 days. Over here, the calculation of days will not happen because we have directly written in the product column red ink interest on the opposite side in relation to the bills receivable given on the credit side. Let us do the product. 4,000 multiplied by 74, 2,96,000. 2230 multiplied by 59, 131,570. 1200 multiplied by 45, 54,000. 1000 multiplied by 33, 33,000. I believe you understood this. Now calculate the balance of product. 296,000 plus 131,570 plus 58,000. 485570. 485570. 485570 minus 33,000 minus 54,000. 398,570. 398,570. Closing date 15,307 by balance of product on this balance of product on the opposite side we need to give interest on 15th March 07 to interest 398,570 multiplied by 10% given in the question multiplied by 1 upon 365. 1 day interest in the amount column, write 109. 109 in the amount column. Now quickly do the totals of amount column. 4,000 plus 2230 plus 109, 6339. 6339. 6339. Balancing figure minus 2000 minus 1000 minus 1200. 2139. 2139. Closing date 15,307 by balance carried down. I believe you understood this. I believe you understood. We are stopping here. We are stopping here. We'll continue from here in the next class. Thank you.